If you've thought at all about how much you can safely take out of your retirement portfolio, you've probably heard of the rule of 4%. It's just a basic calculation that shows you how much can you take out of your portfolio without running the risk of running out of money over a 30+ year retirement. Now, what you probably haven't heard as much about is how do you need to invest to align with the research that this is based upon. In today's video, we're going to talk about the research behind the 4% rule and how it says you should invest in order to be able to align your portfolio with that research. Hey everyone, I'm James Canal, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. We've heard of the rule of 4%. You've maybe heard of Guyton's guardrails. There's all kinds of research that says how much can we take out of a portfolio in retirement without having to be afraid that one day we're going to spend our portfolio down too soon. What we need to do though is understand that just because there's a rule of 4%, or just because there's other research that says you can take out 5% or 6% of your portfolio, it doesn't mean you can invest however you want and still do that. This is actual research conducted based upon actual returns from actual real investments. So let's actually talk about that. Let's explore the research and talk about what investments is that based upon so that we can make informed decisions about how we allocate our investments in our retirement. So with the 4% rule, this is kind of revolutionary research in a way and just talking about how much can we take out of our portfolio. It was done by a guy named Bill Bengen, and it was a very, very simple first research paper. Not simple in terms of the implications, because what it was doing is it was stress testing. What's the highest amount we can take out of our portfolio, regardless of if we're retiring when markets are good, whether markets are bad, whether inflation's high, whether inflation's low. Looking at all these variables to say what's the highest amount we can take out and not have to worry about what's going to happen using history as our guide. It was very basic research, and what it looked at is it looked at a portfolio that had 50% in large cap US stocks and 50% in intermediate treasury bonds. So very basic. No international investments, no small company investments, no emerging markets, no commodities, no different unique types of investments, just very vanilla, half large cap US stocks, half intermediate term US treasury bonds. What that research showed is if that was your portfolio, you could take out about 4% per year and still be reasonably assured that you're not going to run out of money over the course of your retirement. But that research has actually since been revised. So Bill Bengen, the same guy that conducted that original research, in later research showed what if we add small companies to this? What if instead of just being 50% US large cap stocks and 50% bonds, what if we did 30% large cap stocks, 20% small cap stocks, and 50% bonds? What he saw in that paper was that you can actually increase the spending from 4% to 4.5%. Maybe it doesn't sound that substantial, but that's a pretty significant increase in terms of your income you can expect in retirement. And what he showed was by spreading your money out to more types of things, what you can do is increase the amount that you could effectively spend in retirement while still being assured that that portfolio is going to last for you throughout all of retirement. Now that's great research, and it's the foundation of a lot of principles and research that's been done since then. Now, some research that's been done since then, and research that I've talked about in some of my videos, is done by a guy named Jonathan Guyton. And Guyton has something called Guyton's guardrails that says, let's expand upon this a little bit more. And instead of just having money in large cap stocks and bonds, or even just large cap stocks, small cap stocks and bonds, let's spread this money out a little bit more. And let's not just spread the money out a little bit more, let's put some rules in place. Because what we want to know is, can we ever increase our spending? Are there times where maybe we have to pull back on our spending? Do we need to make some tweaks and adjustments along the way? And it's a much more dynamic approach. And what it does is saying, rather than just starting with a standard amount like 4% or 4.5% and inflating that over time, he showed if we put some rules around this, we can actually increase our spending over time, but it comes with understanding you might need to decrease it in some years too if there's a downturn in the market or if spending starts to cross certain thresholds. So with Jonathan Guyton's approach, he tested 3 different portfolios. One portfolio, 50% stocks, 50% bonds. Another portfolio, 65% stocks, 35% bonds. And then another portfolio, 80% stocks, 20% bonds. Looked at different scenarios to say which would maximize the income that could be generated, which of these would minimize the risk of the portfolio running out of money, and just really running a whole lot of scenarios. What his research showed is that depending on the portfolio you're selecting, you can take closer to 5.65% out of your portfolio And as long as you're following this guardrail approach, and as long as you're making the dynamic changes that need to happen along the way, end up spending more over time. One reason that you could spend more with this approach is because you are making adjustments as needed and not just blindly starting with a withdrawal rate and then seeing that through the next 30 plus years. That's one reason. The other reason is he introduced different types of investments into the portfolio. This research, so if we look at his portfolio that's 65% stocks and 35% bonds, what that showed, it was 10% in cash, it was 25% in fixed income, and he used the Lehman Aggregate Bond Index as an example for that, or as a proxy for that. 13% in US large cap value investments. He just used the Russell 1000 Value Index to simulate what that would look like. 13% in US large cap growth investments, using the Russell 1000 Growth Index. 9% in US small cap value, using the Russell 2000 Value Index as a proxy. 9% in US small cap growth investments, using the Russell 2000 Growth Index as a proxy. 15% in international stocks, using the EFI index there. And then finally 6% in real estate, using the Wilshire REIT index for that. So what he showed in doing this is by spreading out your assets more and by following a series of rules that allows you to increase or decrease spending, an investor could essentially increase their standard of living in retirement by a fairly substantial amount and still have the same confidence that their portfolio will last them for 30, 40 plus years into retirement. Now, one thing I want to emphasize with all of this, whether it's Guyton's guardrails, whether it's the rule of 4%, or really effectively the rule of 4.5%, these are all based upon worst case scenarios. And I say worst case scenario using history as our guide. Of course, anything could happen in the future. A lot of this research is just based upon what we've already known to have happened, actual numbers. Things could be better or worse in the future, but as we're looking at this, what Jonathan Guyton or what Bill Bengen were looking for is they were saying, what's the maximum amount that we could take out so that even in the worst case scenario of retiring and having low returns or retiring and having high inflation, what's the maximum amount you could spend and still have the confidence that portfolio would last? What that research also mentions is if you retire and things are good, and if you retire and the markets are doing well or inflation's low or all these good things are happening, 4% or 5.65% is actually much lower than you can actually spend. So it's important to note this is a good starting point, but in some ways I want people to understand they shouldn't be selling themselves short if things go much better in the market or things go much better than the plans that they laid out for themselves. Too often people are under withdrawn from their portfolio, sacrificing things they shouldn't be sacrificing because they're so focused on what does this rule say I can take out, and they're not taking a more dynamic approach to that. And I want people to understand that if things are going well, it is okay to spend more than that sometimes, but that's where having a more dynamic plan in place that knows when to adjust, when to increase, when to decrease helps to maximize the income you can safely spend over the course of your retirement. So both of these approaches are fairly conservative in the sense they're looking at what's the most you can spend, whether times are good or bad, and be okay over time. What they don't take into account is what happens more often in real life, not just in theory. So in theory, you retire and you have an amount that you want to spend, and that amount increases by some level over time as inflation increases. But in practice, it doesn't take into account a few things I want people to be mindful of, so they know not just how to invest, but some of the things that could potentially skew this or derail this if they're not taken into account in a proper retirement plan. Number one is it does not take into account other spending goals. Let's say you retire with $1 million and you've determined that based upon your mix of investments and your desired spending and what you feel comfortable with, you can take out 5% per year of that portfolio. You say, perfect. We need $50,000 per year from our portfolio. We have $1 million, so $1 million times 5% is $50,000. We've hit the level where we can now live on our portfolio. Well, retirement's going great, and all of a sudden the couple says, you know what? We can finally buy that boat that we've always wanted. We want $100,000 to go buy a boat. Well, it doesn't necessarily work that way because what that's requiring is a one-time withdrawal from the portfolio of $100,000. Now, the portfolio is down to $900,000, and 5% of $900,000 is $45,000. So unless there's a corresponding decrease to the spending, what people need to realize is retirement isn't just a linear line of living expenses. We need to factor in these one-off expenses. We need to factor other things that happen along the way. So it's not just how much do we need to cover our basic living expenses, but are we building in a buffer for a second home, or to send kids to college, or grandkids to college, or to buy that boat, or whatever it is that's most important to you, make sure that that's reflected, because some of this research is just based upon a starting portfolio value increasing over time with inflation, not looking at the cars or other things that need to be purchased along the way. Another thing that can potentially decrease this or derail this is legacy goals. Some people say, great, this is how much I can spend, and we show it, and it gets spent down over retirement. And they say, well, what about the legacy I want to leave? I wanted to make sure I left a certain amount to children or charity or grandchildren. Well, that's not factored into this research. This research is based upon how much can you fully spend in retirement and not have to worry about running out of money in most cases. But if there's a legacy goal, you need to tie that in too. Whether that's by setting a certain amount of your portfolio aside just for legacy, whether it's decreasing your spending so your portfolio can hit some target amount by the end of a lifetime, really factor in a plan that's going to account for that too, because this spending research is just based upon you maximizing your spending. Number 3, the third thing, and maybe the most common thing that most people don't think about when looking at this research, is even if they're invested the right way and they understand the withdrawal rates, they don't think about taxes sometimes. I'll go back to that $1 million portfolio example again. Say you want $50,000 from your portfolio, and you've saved up $1 million in your 401k, and you say, great, I can retire. I can take out 5% per year because that gives me $50,000. Well, it does until taxes come into play. And depending on what state you live in and depending on other income sources, if you have $1 million that's generating 5% per year, that's $50,000, but after taxes might only be $40,000 or so. So we have to factor in the tax impact of not how much can your portfolio generate, but how much can it generate after taxes. And so when we look at this isn't necessarily the rules don't take taxes into account. It's our perception of the rules that sometimes don't take taxes into account. The rule just shows how much can some asset allocation generate in terms of maximum income level. It's our job to understand whether that's in an IRA or a Roth IRA or a brokerage account. The after-tax amounts in each of those is going to be different. So make sure you're factoring taxes into that. Another big thing is, what if you don't retire at the traditional age of 60 or 65? These rules are based upon how much can you generate in income for 30, 40 years or so. But if you have a very early retirement of say 40 or 45, 30 to 35 years might not be enough. So if you're retiring at the traditional age of 65 or somewhere between 60 and 70, great. These rules are a very, very good place to start. But if you're retiring earlier, you may need to adjust these numbers down in terms of the withdrawal rate you can sustainably take. If you're retiring later, you can increase these numbers higher, because what they're based upon is how do we ensure we have enough income to last for 30 or 40 years. But if you retire at 70 and you say, you know what, life expectancy in my family, it's not great, to maybe only have 15 years or so where I want to fully enjoy this. Well, do you ramp spending up, understanding that that portfolio wouldn't last for a full 30, 40 years, but maybe you don't need it to? So I want to impress upon people that these rules are great places to start. Understanding how much income can be generated, understanding how to invest to align with these rules. But this is just a starting point. And factoring in your retirement ages, factoring in taxes, factoring in those one-off expenses that may come off, factoring in the fact that you may have more than enough to generate a whole bunch of income and not even need to spend the full 4%, 5%, 5.5%, whatever it is. Take that into account when designing your portfolio and planning, because not every single person's case is exactly the same. And the last thing I want to impress on people is that fact, again, I want to reiterate, these are based on conservative scenarios. This isn't me going out and telling you to spend a whole lot more than these rules allow for. No, I like using these rules as protection. But if you're not dynamically revisiting this each year, saying, is the market doing well? Is our spending going down? Is inflation staying under control? As those things happen, you should give yourself more permission to spend more if you desire to, because your portfolio can often support more. It's just saying that if we do go through a period where returns are lousy and inflation is high and bad things are happening, that's where these guardrails provide some protection, or the rule of 4% provides some protection of saying, at least what we know historically to be true, these are the rates of return and these are the rates of withdrawals that we can take while still being reasonably assured that we'll be okay over time. Thanks again for watching. This is James Canal with Root Financial Partners. If you've enjoyed this video, please be sure to share it with someone else who you think could benefit from it. And also be sure to like this video and subscribe if you haven't done so already, so you get more great content just like this. If you want additional information on how you can secure your retirement, be sure to check out our podcast, Ready for Retirement. And if you're interested in seeing how our services help people guide them through their retirements, make sure to check us out online at rootfinancialpartners.com.